All right, I have to admit, I mean, it's certainly the action in Bitcoin that has me focused on the gold market right now. The Bitcoin movement has been pretty dramatic on the upside as it has moved up beyond the $4,200 mark, which is just incredible and massive gains for the year. So I've given it a lot of thought, and I think there is some huge meaning in that move in Bitcoin. Some of it recently, maybe the move from 3,500 to 4,200 has been technical. I wouldn't be able to explain it to you. There's been a software change in there. There's been a split to Bitcoin Cash also, and it was about competing with the smaller cryptocurrencies, specifically Ethereum. So there's been some technical changes in there, and that has brought some more buying coming in, I think. But overall, I mean, the move in there has been dramatic, and even getting up to 3,500 was a massive move for the year. Also, the long-term scenario on the dollar is really bad based on the analysis that I see in here. So we're going to want to take a look at some of these charts and get a sense for what the dollar scenario is, the gold scenario is, and see how if this relates at all to what we see in this move in Bitcoin. So it's really got me thinking about it. So when you think about the besides the fact that the long-term scenario for the dollar is bad, when you look at Bitcoin relative to the dollar or all currencies, in that case, currencies, paper currencies, have crashed. Now that's crashed related to Bitcoin. So most people don't look at it that way, and when you look at the overall market cap of Bitcoin, you say maybe it's not that significant. But there are forces that are driving the Bitcoin market, the cryptocurrency market, that I think are significant. And the question is, are those forces the same for gold than they have been for the cryptocurrencies? There is, I think, of course, huge speculation going on in there also, and we've seen massive volatility in there, just big swings. We saw it move from 3,000 to 1,800 and then bounced immediately back up to 2,600 before it then surged again up to 4,200. So it's been, you know, some huge speculation and giant volatility in there. But it feels to me like it's a flight out of fiat currencies. So what if investors really do, I mean big investors, people that are focused in on world scenarios, what if they actually see a reason to be moving out of fiat currency? And that's what we're seeing as Bitcoin being the canary in that coal mine. And that there is a potential that they want to do that because there is actually some inflation coming down the road. I don't know if it'll be, if they think it's going to be significant, you know, maybe it's Venezuela that is stimulating them to think so, but they want to move out of fiat currency and into something else. That's what it really feels like to me. So if they really want to do that, then you have to think about the size of the markets, right? So the Bitcoin market now has moved up over $60 billion. That's the market cap in there. It's basically minuscule. When you think about all the cryptocurrencies, well, they're about $125 billion. So if some real players, a bunch of them, you know, decide that they want to move out of currency, paper currency, and you notice I don't call that money. I mean, it's really not money anymore. It's just simply currency. Those small market caps don't allow for very much, and that's why we see some big moves. However, if they really do want to move out of fiat money, then fiat currency, then when you think about the market cap of gold, all of the gold in the world that there is has a value of about $7 trillion. So then you can get some real money moving in because they don't worry about the size of the market cap. And then when you add in all of the other variations of derivatives plus silver and platinum and everything, it's a massive market. And if real money wants to go somewhere out of paper currencies, well, and if Bitcoin is signaling that, then you get an idea of the kind of movement that can happen moving into the metals markets. So the central banks, they've been filling the hole that they created. You've heard me say that before. It all goes back to Greenspan, where Greenspan started this trend of super hyperactive Feds that are willing to bring interest rates down to Greenspan 1% for some year and a half. And of course, Bernanke and then Yellen being in zero interest rate policy for some 8 years. So with all this other stimulus going on, they're trying to fill up the hole that they created, starting with Greenspan bursting the bubble that he created with the real estate coming apart. And then this long period in here of what a lot of people are calling the everything bubble. So if they have filled the holes that they created, all the central banks around the world, and you have Japan getting 4% growth rate right now in this last quarter, and the U.S. Hovering around 2% growth rate. If that's the case, and interest rates do start to go up because that would be the normal forces, then believe it or not, that is inflationary. The reason is because you get real pricing discovery, and then what happens is that prices can actually go up. We're starting to see some wage inflation come in, and we're starting to see a little better inflationary numbers out of Japan, and there's a sense that maybe they have filled that hole up enough that they created through all that deflation. And the Fed causes these huge swings of inflation and deflation, and the next one would be inflation, right? So if that's the case, and if the patterns hold up that we're going to look at, that the dollar in this collapse mode, and the gold market, which tends to move inverse to that, then exploding, then buying coming in, if Bitcoin is a signal, it's going to be some big move. And if inflation comes back in, if the Fed has to scramble, then that scrambling is going to mean that they move interest rates up a lot faster. And if they have to respond to inflation with interest rates moving up a lot faster, then, of course, the stock market is not going to like that. And then the only place to put the money, with bonds collapsing and I think the stock market following it, somewhere down the road, this is a big scenario, right, because we're in big picture analysis here, then the gold market is going to be the only place, and we could really see gold accelerating to the upside. So you might say, well, everything we see, says that if interest rates, that the bond market and the gold market kind of track each other. In other words, when bonds are rallying, we see gold market rally. It's flight to safety in both, right? And when the bond market breaks, like we happen to be seeing today, bonds fell about a point. We saw gold giving up about $12, $13. So they have tended to track each other a lot. And I'm going to show you a chart on that actually proves it. And then I'm going to show you something that disproves it, because in this thought process, in this scenario that I'm looking at, where interest rates spike as a response to inflation coming in, then I have to also be able to prove there are periods where gold goes up under those scenarios where most people would not expect that. So let's just take a quick look at some charts in here and get a sense for what I'm talking about. You just saw the opening of one of our special member videos. If you'd like to watch the rest of that video and have access to our huge library of videos for traders and investors, just go to askSlim.com. In fact, right now, if you write to me, slim@askSlim.com, I'll send you a special half-price link for our entire video library, 1 month viewing of all of our videos, $16.50. I hope you write to me.
Going to the city and I'm gonna do a